Yes. Good morning to all of you. This is Dr. Shankar Babu. I would like to teach the cash flow statement. Why do we need the cash flow statement in the business? And what is the necessary of preparing a cash flow statement of every company? So let us discuss today about this inflows and outflows of the cash and cash equivalents. Every business prepares a comprehensive income statement at the end of the financial year that represents the profit of the company, and also it's prepared the statement of financial position to know the financial position of the business. While preparing the comprehensive income statement, the people can know the profit of the business. So the profit which shows in the comprehensive income statement, it doesn't mean that you are having that much of cash balance in your hand. Why? Because profits can be manipulated, and profit sometimes it varies because of changes in accounting policies and procedures and methods. So most of the shareholders will be misled because of profit showing in their comprehensive income statement. And not only the shareholders, but also stakeholders also misled by seeing the profit in the business. So that's why cash flow statement is very significant to know the inflows and outflows of the cash of the company. For example, if you approach the banker for any loan, so automatically every year you will prepare some financial statements as per International Accounting Standards 1, which guides you how to prepare the financial statements. There is comprehensive income statement, statement of financial affairs, cash flow statement, and statement of changes in shareholders' equity. So all these statements will be prepared by a company. It is a mandatory. But whereas the banker will choose, while grants the loan, he will always go through your cash flows. Why? Because banker wants to know your financial position, whether you are can repay the debt which is lent by the company banker to the company. So that's why cash flow statement is very mandatory. It is not an optional whether to prepare or not to prepare. Why? Because cash flow statement gives a whole picture of your cash and cash equivalents. That's why cash flow is very important, because the banker or the financial institutions or any creditor, before they lend the loan to our company, they would like to know our inflows and outflows. It gives a picture how you are financially strong, or are you facing a financial breathing or a financial crisis. Unless you have a good financial stability, unless you have a good liquidity position and solvency position, you cannot repay either short-term debts or a long-term debts. That's why the banker will test your solvency. The banker wants to test your liquidity. If your profit and loss account, that is comprehensive income statement, shows a profit of $100, it doesn't mean that you are having that much of cash, and that shareholders will be misled, and the stakeholders will be misled, and the financial institutions also will be misled because of these profits. Profits, that's what can be manipulated because of changes in policy. Sometimes you can change the policies, like depreciation. For example, you're using straight line method. The next year want to change for the diminishing method. In the same way, valuation of inventories. In the first year, you used the simple average method, and the next year successive years, you want to change into the FIFO method, first in, first out. So methods cannot be altered, cannot be changed as per international accounting standards, but sometimes it is a die and need. Then you have to change. When you change these methods and policies of accounting, definitely it shows the impact on the profits of the company. Your liquidates may comes down or your liquidates may raise up. So that doesn't mean that you are having that much of cash. That's why cash flow statement is very important. Every financial institution grants the loan basing upon your financial ability. If you are financially debilized, no institute will come forward to grant the loans to our organization or a company. So let's know, how do you prepare the cash flow statement? We all know that the cash flow statement, as per International Accounting Standards 7, it is a mandatory. Every company should prepare the financial statements as well as the cash flow statement, because it is the most important component to determine your liquidity position and solvency position. For example, if the banker wants to grant a bank overdraft, a short-term debt to you, the banker should know whether you are able to pay. The debt can be emancipated within 6 months or not. So if you have that ability, then the banker will grant the bank OD. That means he will test your liquidity position by taking your quick ratio, quick assets by quick liabilities, or liquid assets by liquidity liability. Then you can determine your liquidity ratio. Then the banker can cognize whether you can easily repay the short-term debt. Then the banker will grant the loan. In the same way, whenever the banker wants to grant a long-term loans, even the debenture holders or even the creditors, when they want to lend the loan to our company for a long period, definitely they test your solvency position. Without testing the solvency position of the company, no financial institution, no creditor will come forward to grant a loan to your organization. That's why it is very important. Cash flow is a very important component. Solvency can be tested basing upon your cash position. So that is also very important. So now let's know, how do you prepare the cash flow statement? So mainly the cash flow statement has been classified into 3 types. And this cash flow statement has 3 activities. One is the operating activity. Another one is investing activity. And third one is financial activity. So let us discuss what is the operating activity. So whatever you derives the economic benefit through activating your operations of the business, or through the operations, what you get the inflows by making some operations or performing some activities, that will comes under operating activity. Operating activity is nothing but the sales and purchase of goods and services. So you will take the sales. Out of that, if you deduct the cost of goods sold, you'll get the gross profit. After the gross profit, definitely every business has to spend some operating expenses like administration or like office expenses, selling and distribution, etc. These are mandatory to sell your goods in the market. After deleting that, you'll get an operating income. This is also called as EBIT, earning before interest and tax. This is also called as PBIT, profit before interest and tax. So this is known as operating income. For this operating income, you also have to adjust the working capital. What is working capital? So working capital, cash flow statement is prepared on the basis of cash, but working capital is prepared on the basis of accrual base. Now you have to convert all the accrual base into the cash basis. That's why you have to adjust working capital here. So working capital is nothing but the capital which is needed to meet the day-to-day expenditure, or it is nothing but a distinction between current assets and the current liabilities. So this working capital has to be adjusted to the operating income to find your real cash in your hand. So let's know what are those current assets. Stock, debtors, bills receivable, prepaid expenses, short-term investments. So these are all considered as current assets, which can be changed into liquidity very easily. Those are all comes under the current assets. All current assets, you are given a period for 2 years. Why? Because every comprehensive income statement or comparative will be prepared, or a cash flow is prepared for period of 2 years, last year and current year. Otherwise, you cannot compare your current year information with the last year unless you provides the both years information. For example, let me take the stock. Last year stock is 1 lakh, and for example, 1999 and 2000 year the stock is 1,20,000. Now the stock is increased. That means you have manufactured the stock, your cash is moving out. When stock increases, that means current assets are increases. So the cash is going out. You may be buying the stock or you may be manufacturing the stock. When the cash is going out, so it should be minus from the operating income. In the same way, if the last year stock value is 1,20,000 and current year stock inventory is 1 lakh, now the stock has comes down. It has been lessened down by rupees 20,000. That means you have been sold. Stock has been sold. When the stock has been sold means you are getting cash. So that means decrease in all current assets is to be added and increase in all current liabilities also is to be added. It is reverse. For example, if you take the creditors, it is a current liability. Creditors, bank overdraft, bills payable, outstanding expenses, or provision for taxations. Any liability which is to be disbursed within the period of 6 months, that is considered as current liabilities. So these current liabilities, I will give one example. If the creditors is the last year is 1 lakh and current year creditors is 1,50,000, that means you are borrowing the loan from the creditor. Why? Because the creditor has been increased by rupees 50,000 comparing to the last year. You are getting cash into your hand, therefore it is to be added. I think you understood. Working capital, before you adjust, you should compare the current assets and current liabilities. If current assets increases, it is to be added. And current liabilities increases, it is to be added. But if current assets increases, it is to be minus. And if it current liability decreases, it is to be minus. Then you'll get operating income. Out of this operating income, if you borrowed the debentures, so you have to pay the interest to the debenture holders. So that is also to be deducted from your operating income. And if you are liable to pay the tax to the government, the taxes also is to be deducted from the concerned operating income. So then you'll get net operating income, maybe a loss or a profit. If you get a negative value, it is treated as a operating loss. If you get an income, you'll get an operating income. So this is the first activity. I think you understood what is meant by operating activity. Now let's come to the second activity. This is an investing activity. So you all know that investment, sometimes you may invest in non-current assets, or you may invest in some other fixed assets. Non-current assets and fixed assets both are same. So these assets are not meant for sale. These assets are meant for to run the business, to run your organization. But if the life of the asset is expired, if the stipulation period has been expired, then you have to dispose that assets in the market and you have to replace the new assets. So we all know that concept. That's why according to the accounting concept, always the fixed assets or a non-current asset should be shown at cost price only. Why? Because you treat your business as a going concern concept, then it is treated as and recorded according to the historical cost, not at the market price or the fair market price. For example, 2 years ago, you purchased a land or a building or a machinery for 1 lakh rupees. So there is an accumulated depreciation of 20,000. After deducting 20,000 from your 1 lakh machinery value, your book value is 80,000. Is it called as book value, or it is also called as carrying cost? Always it should be recorded at same price, that is 80,000, unless you are intended to sell that asset. If your business is not a going concern, that means you are going to shut down the business. You are facing a lot of detriments. You are unable to continue the business. You want to shut down. Then it is called as a not a going concern. Then you have to dispose all the assets. You have to disburse all the liabilities. When you sell off all your non-current assets to pay off the liabilities of your business, then you have to show your all fixed assets, that is non-current assets, at now at market price or fair market price. Why? Because you are closing down the business. Your company is liquidated. You no more have a right or empowered to continue the business when you are on the verge of the liquidation or the verge of insolvency. So now you have to dispose the assets. What will happen automatically? The non-current liabilities, the long-term liabilities also will be turned as a short-term liabilities. You have to dispose every liabilities. You have to shut down the business. So that happens in the case of when the company is liquidated. So when you sell the assets and when you purchase the assets, the cash may go south if you purchase the non-current asset. If you sell away the non-current asset, the fixed assets, the cash may comes in. If cash is coming in, it is to be added. And if cash is going out, it is to be minus. So the sale and purchase pertaining to these fixed assets, whether you get a positive value or a negative value, that will be shown as income from investing activity or loss from investing activity. So this is the second activity, that is investing activity. What is the next one? Financial activity. What is meant by financial activity? You all know that the finance plays very important role. Finance is the lifeblood of industry. No business can sustain without having a firm financial stability. How does a man needs a blood in his corporal to survive? In the same way, every industry needs the blood. Every industry needs the finance. If you do not have an accurate, if they do not have strong financial ability, that company cannot sustain and cannot continue for a long period. Just like a human being, how does a man needs a blood to survive? In the same way, every industry needs a finance. So what are the activities comes under the finance? For example, if you want to issue the shares. Last year, your share capital is 1 lakh. Now you issued an additional share capital of 20,000. 1999, your capital is 1 lakh. And coming to the 2000, your capital is 1,20,000. Now the share capital is raised by 20,000 rupees than the previous year. So when you are raising the capital, that means you are accumulating and amassing the funds from the public. Your cash is coming into your business. So this is called as issue of shares. When you issue the shares, the cash comes in. You have to add that cash. You have to adjust in the financial activity. In case if your capital is the last year is 1,20,000 and this year your capital is 1 lakh, your capital has been redeemed. When capital increases, it is treated as raise. The cash flows inside. If the capital is reduced than the last year, it is treated as cash outflow. That is called a redemption of share capital or repayment of share capital. So this is treated as minus. In the same way, debentures. Last year, you are given a debentures of 1 lakh rupees. Current year, a debenture value is 80,000. So the debenture value has been lessened down by rupees 20,000 than the last year. That is treated as a redemption because you issued the debentures, the time has been expired. When the time has been expired, because the debenture is nothing but a long-term loan which is borrowed by the company for a certain period. After the expiry of the stipulation period, you have to repay to the debenture holders. Until that, you will pay the interest. They are not the owners. They are just the lenders. They will get a fixed rate of interest until their money is repaid. So when the debentures value comes down, then the last year, automatically it is treated as the debentures, treated as a redemption. When you redeem or you redeeming the debentures, the cash is moving out. Therefore, it is considered as minus. Cash is going out. In case if the debenture value is reverse, Last year 80,000 and current year 1 lakh. That means your debentures is increased. That means again you are issued the debentures, you raised the funds through the long-term liability. The cash is coming in by way of debentures. So now the debentures cash is coming in, issue of debentures, it is known as positive. That will be added. So shares or debentures or any loans or any public debts, they all comes under the financial activities. The first activity is operating. The second one is investing activity. I told you that if you compare the fixed assets from current year with the last year, if fixed assets increases, it is treated as purchase. If fixed assets is decreases, it is treated as sale. And the difference will be shown in the investing activity. And the third one is the financial activity. And if you add these three activities, you will get one balance. That balance is known as cash. So for this balance, that means net increase or net decrease, through cash flow statement. For this net increase and net decrease, you have to adjust your opening cash balance or bank balance. Then you'll get the cash at the end or bank balance at the end. So in the balance sheet, if you are given the cash and bank balances opening and closing, that will not be considered while preparing the cash flow statement. Why? Because the cash flow statement is mainly prepared to determine the cash at the end in your hand. When you want to determine, you have to make all these, you have to summarize all these activities. The summation of these three activities, the operating, investing, and financial activity, automatically these three activities will be considered as a net increase or a net decrease. If you get a positive value, it is a net increase. If you get a negative value, it is a net decrease. For this, you have to add up the opening cash, then automatically you can compute the closing cash or the cash at the end. So, friends, cash flow statement may be prepared or may not be prepared. It is not an optional. It is a mandatory as per Indian Accounting Standard 7 or International Accounting Standard 7. Every business and every company has to prepare the cash flow statement. Why? Because I already told you, profits can be manipulated sometimes due to changes in accounting policies and procedures. And stakeholders may be misled by seeing the profit in your P&L account. Shareholders may be misled, but the bankers cannot be misled. Financial institutions, they'll be very precaution before lending the loans to our organization. Why? Because they will always ask you to submit all your financial statements. That is your comprehensive income statement, statement of financial position, or changes in your equity, or some notes accounts, or another important is cash flow. But out of these, amidst these, the cash flow statement plays a pivotal role, indispensable role to grant the loan to you or organization. Why? Because they want to test your liquidity. They want to test your solvency position, either to grant a short-term or long-term loans or debts to your organization. Not by seeing your comprehensive income statement. Why? Because I told you comprehensive income statement can be manipulated because of changes in policies and methods. So this is the most important. So we can also have a discussion regarding this. I can give an illustration also. This is very important. So cash flow is one of the most important component of the financial statement. But every company has to provide a 2 years information in order to prepare the cash flow statement. Unless you are provided the 2 consecutive years information, you cannot prepare either cash flow or a comparative income statement or a common size income statement or a trend values, whatever it may be. The financial statements cannot be prepared without having a 2 consecutive informations. Why? Because only a 1 year information is not sufficient to prepare a cash flow either in direct method or indirect method. So that is the one of the most important component. I think you understood. This is the regarding this cash flow statement. So if you have any doubt, you can